please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi guys, welcome back. Well, the month of August has been good for the commercial vehicle space. Eicher Motors is the one that we're tracking right now. It recorded a growth of almost 33% on a year-on-year basis in the month of August. Sales coming in at 6,069 units. Vinod Aggarwal, the MD and CEO of Volvo Eicher Commercial Vehicles, joins us now to talk about that. Mr. Aggarwal, good morning. You know, a lot of your peers like Ashok Leyland, M&M, etc. have scaled up their commercial vehicle full-year growth target. What would your own expectation be by the end of FY19? What growth are you looking at? And would it be higher than what we spoke about earlier?
No, if you look at overall CV industry, I think we are witnessing record growth. First 5 months, the growth in the heavy-duty trucks has been more than 50%. Similarly, in the light and medium-duty trucks also has been more than 50%. Buses has been more than 20%. So all the segments of the industry are growing. And if you drill down further, I think two specific segments stand out very clearly. One is the infrastructure segments, where the construction trucks have grown by more than 100%. And if you look at the 12 to 15 ton segment, again that segment has grown by more than 80%. So and 12 to 15 ton is driven by you can say the e-commerce, and the construction trucks are driven by the investments in infrastructure. So these two segments, I think, are continuing to drive the industry. And in line with that growth in the industry, in VCV also, we have grown by almost 40% in first 5 months. So we are doing very well, and industry is expected to do well because replacement demand is very strong in anticipation of the BS6 norms, as well as lot of focus on the productivity from the various customers. For example, now if earlier they were tolerating the delay in the delivery of goods, now of course there is a lot of focus on the delivery in hours, in days, or in there is tremendous focus. And as a result of that, all these transporters they are replacing their trucks with the more modern fleet. They are getting into more and more higher tonnage and better productive trucks, which is leading to this huge growth in the demand.
Okay, Mr. Aggarwal, good morning. You know, for you, the last 2 quarters have been good in terms of margin as well. You've seen growth in numbers, and that's been aided by margins. Is that trajectory also going to be intact from here?
No, if you look at the going forward growth in the balance 7 months, last year in second half, the growth was huge growth. We had experienced huge growth in the second half. So now onwards, you will see a base impact, because if first 5 months we have seen a growth of almost 50% in the industry, you cannot expect the similar growth in the second half, because the base is very high. For example, if you take heavy duty trucks, if last year the total market was 267,000, out of that maybe around 95,000 was in the first 6 months, and balance around 170,000 was in the second 6 months. So with 170,000 base of second 6 months, I think this year second 6 months again you will not experience the growth of say 50% or very high double-digit growth. So you will see lesser growth in the second half because the base itself was very high. But then overall for the full year still we are expecting double-digit growth, because first 5 months itself is around more than 50%. But so, and in line with that, of course, we will also see good growth for the overall for the full year, because first 5 months we have 40%, and balance 7 months we will not have similar growth, but we will have good growth.
So when you say we are looking at double-digit growth, I mean, it could be anything, right? It could be 10%, it could be 20%. You're sitting on a base of around 66,000 units as of FY18. Even if we look at, say, a 15% growth, so that would be somewhere around 75,000 units. I mean, is that a realistic estimate by the end of FY19?
No, that will, if you look at the current situation in the market, that looks to be doable,
Okay, so 75,000 is doable. I mean, that is still a 15% growth. What kind of market share are you sitting on currently, and have you seen any change in market share over the last, say, 3 to 6 months?
we are continuing to be around, in heavy duty trucks around 5%, and light and medium duty trucks it hovers between 30 to 32%, and in buses we continue to be around 16 to 17%. So we have not seen growth in the market shares, but I think we are continuing to hold on to our market shares, and of course since the market continues to be highly competitive, discount rates continue to be still very high. So due to that, of course, we are not running after the market share. We have to manage the price, we have to manage the margins, and at the same time we have to manage the volumes. So we are not running after the market share. What matters is that the quality of the sale that we make, that has to be good.
Okay, Mr. Aggarwal, the other point is this diesel prices. We have seen a massive increase now over the last 2 or 3 months. At what point does it start to impact demand?
No, definitely. Since if you look at current situation, now you have the festive season around the corner, and FMCG or white goods demand is very high. The government slashed GST rates on televisions or fridges or washing machines. So as a result of that, the demand for all those white goods or FMCG goods continues to be high. Rural economy is good. So when the demand is high, I think the transporters will pass on this increase in their costs. But beyond a certain point, of course, it is not going to sustain, because right now not only the fuel prices are going up, but the interest rates are also inching up. Already the interest rates have gone up by almost 100 basis points for these customers. So these are the two, I think, negative factors. But at the same time, as I mentioned, replacement demand is very strong, and then BS6 related anticipation, and then focus on the productivity and replacing the old trucks with the new trucks, and then of course the axle loads norms. That is also leading to more and more modernization now. So these are the positive factors which will contribute to the growth. And it will continue to be driven by the replacement of old fleet with the modern trucks.
Okay, in fact, I wanted to ask you.
Very important now. And when that is so.
Sure. I just wanted to ask you on the new axle load certificates itself. Have the vehicles with the new certificates started selling on the roads? And what about the existing vehicles? What permissions do they have to take in order to ply?
No, there the government had issued some advisory to the regional transport authorities that they can continue to register the current vehicles at the higher norms. So the customers are able to get the registration of the current trucks with the higher loads. So in a way, it is helping the customers to load more on the same trucks. But at the same time, all of us are working on coming out with the new products, because we will have to make some changes. We already have announced the 55-ton truck against 49-ton earlier. So we are the first ones to come out with 55-ton, and you will see more and more trucks coming out with the newer norm, and those will be with the proper engine and new tires, change in some brakes or steering system. So there will be some changes so that we are able to give much better and much modern trucks which are suitable to carry the higher loads. But at the same time, currently the customers are loading the existing trucks as per the new norms.
Okay, all right, Mr. Aggarwal, we run out of time, but thank you so much for joining us and giving us, your view on the segment. So, 15% growth in volumes is possible. 75,000 is what they're realistically looking at, which is really good. Earlier, they spoke about a double-digit growth. Now they've quantified that. They've said it could be more than 15%. And the construction trucks have seen a huge pickup. 100% growth is what they've been witnessing there. But let's move away from commercial vehicles and talk about the pharma space, because that's been one space in focus for the last many days. Torrent Pharma is on our radar right now. If you're wondering why, Ekta's here to give us more. Ekta?
Hi, thanks for that, Sonia. Well, you know, it is sentiment negative news which has come in for Torrent Pharma, where the US FDA in a press release last evening has mentioned that they have found an additional cancer-causing substance in one of Torrent Pharma's recalled products, which is basically valsartan, valsartan. It's a heart failure drug, and there were multiple recalls which were made by the US FDA as well as the European authorities because of a faulty API which is used in manufacturing the drug. The API is produced by a Chinese company called ZH Pharma, and that was expected to have one cancer-causing substance which was found, which is called NDMA. So this recall had taken place, and Torrent Pharma is using that particular company's API, and hence their products were recalled. So the FDA has now released an additional statement last night saying that the recalled products of Torrent in fact contains a second cancer-causing substance. So it's a negative impact for Torrent Pharma, and we could probably expect some amount of escalation in recalls for the company for this particular drug.
Okay, Ekta, thanks a lot for that. So that's Torrent Pharma. There was a bit of a rally, but that's getting sold into now. The market really is looking good now. You know, the stock that we just spotted about half an hour back, Piramal Enterprises, just pull out that stock intraday once again. In fact, today is the day of NBFCs. So not just Piramal Enterprises, but there are others as well where we're seeing some gains. Mahindra and Mahindra Financials now moving to the high point. Apart from that, just look at Aurobindo Pharma. It had that 3 or 4 days consolidation after that big run, but now fresh buying, and how 4% higher is what you have on Aurobindo Pharma. We'll take a break. Up next, we'll track the expectations from the Prime Minister's Economic Review meet this weekend. Nomura's Sonal Verma and JP Morgan's Sajid Chinoy will join in. Stay tuned.
The markets are looking good, and there is a reason behind that. The big story this morning, ahead of the Prime Minister's economic review, top government officials have said that they are vigilant and will act only when appropriate. Shireen Bhan is here to give us a check on the key issues. Shireen, over to you.
There is a crucial meeting that the Prime Minister is holding on Saturday with top government ministers and officials to review the economy. The message that we are getting from our sources is that while the government is vigilant and weighing its options, it will only act when it feels appropriate. So the message is that they may hold fire for now. The sense is that there is no need for a knee-jerk reaction on the rupee because the economic fundamentals continue to remain strong, and also very mindful, especially within the finance ministry, that fiscal prudence is crucial to ensure that bond yields don't spike further and that the rupee stabilizes. In fact, the finance ministry is clear that it wants to stick to the fiscal deficit target, but remember, it is an election year, so eventually this will require political support and a political call. Specifically on the issue of oil, political demand in the first quarter was to lower fuel prices by almost 5 rupees a litre. Now, the demand was that the centre cut excise by 2 rupees, the state reduced VAT by 2 rupees, and OMCs absorb a 1 rupee hit. But that demand was turned down. The finance ministry clearly believes that it is not advisable to go back to either a subsidy sharing mechanism or act on cutting excise just yet, because that will have a multiplier impact, because the signal it will send out will have an impact on bond yields and then consequently on interest rates, making things even worse for the government. So the path that they would like to take for now is to wait it out, to see how the Iran sanctions impact the oil markets, and maybe, if need be, act closer to November post the Iran sanctions coming in. Remember, the government is weighing its options on oil payment for Iranian crude, also hopeful that the dialogue with the US on importing Iranian crude will be fruitful. The message that the political class, especially within the BJP, is going to be sent out is that an excise cut at this point in time will restrict the government's ability to spend on things like Ayushman Bharat, which is the Prime Minister's health insurance program, and other development schemes. So that's going to be the sales pitch to the leaders within the BJP. Separately, there is concern on GST collections, on GST revenue. But North Block hopes that the direct tax mop-up will offset the shortfall on the GST front. So at this point in time, extreme caution on announcing any other kind of cut when it comes to the GST, and hopeful that things will pick up there. So net-net, the view is that Wednesday's fall and the dramatic recovery in the rupee suggests and indicates that there was overshooting, and that India is in a much better position among the emerging markets because growth is strong and our fundamentals are good, and hence the government believes that the currency should stabilize.
Okay, thanks a lot for that, Shireen. In fact, we have two guests joining us to comment on this. Sonal Verma, the MD and Chief India Economist at Nomura, and Sajid Chinoy of JP Morgan is with us. Thanks a lot, guys, for joining us. Sajid, I want to come to you. It seems like the government may not do anything tomorrow. It may hold fire, as Shireen was suggesting, and it may just be a review of, the macroeconomic environment. How do you see all of this play out? Because we were talking to Jahangir Aziz a couple of days ago, and he said the need of the hour is a rate hike by the RBI. But, the government is not panicking at the moment. What do you see as the way forward?
Morning, Sonia, and that's the right approach. I think the government should not panic. There has been a fundamental base adjustment of the currency in the last few months, and I think that was required, that was necessary, that was desirable. It was mostly in line with other emerging market currencies. What you've seen the last 10 days, I would argue, is a little bit of overshooting. And this is typically what happens when currencies begin to correct. Sometimes misalignments develop because they overshoot in one direction. So I think all that is required at this point is a signal from policymakers that if the rupee does overshoot, they stand ready to take whatever actions are necessary. And I think sometimes it's just these signals that are required to change market behavior. What we've seen in the last couple of weeks is, a self-fulfilling prophecy. Exporters have stood out, importers are front-loaded. You can change all of that if you signal that beyond the point the government stands ready. So I won't be surprised if nothing is done this weekend. I think that may well be the appropriate strategy in the sense that this could be a long, hard fight for emerging markets. The Fed is on a multi-year rate hike cycle, and you don't want to use up your silver bullets too quickly. I think what the need of the hour is to be orthodox. It's music to markets' ears that the government reiterates again and again that they will stick to the fiscal target this year, which is the right message to send. I think the RBI has shown us in the last couple of meetings that they stand ready to raise interest rates, if inflation concerns were to arise. We expect that in October we will get another rate hike. So I think if you just, do the orthodox thing, tighten fiscal, raise rates in a manner that does not betray panic, sometimes these things boil over. So I think the response so far has been appropriate. And I think the message on Wednesday was that if there is overshooting, the government has enough instruments here to try and correct that.
Okay, so only a signal from the government is enough, and that's what they've been doing, right, so far. Sonal Verma also joins in. Sonal, we were speaking to a currency expert a while back, and he indicated that there could be some possibility of the government reopening the forex swap window to meet the dollar requirements of oil marketing companies, etc. What are your own thoughts? I mean, do you expect any measures of intervention tomorrow, or would you concur with Sajid's view that it's just going to be a signal from the government that they will support as and when required?
I would broadly concur with Sajid on this. I think there's absolutely no reason to panic. And while the memories of 2013 are very fresh in all our minds, the fact is that there are, multiple differences as compared to back then. First of all, our own fundamentals, whether on inflation, current account as well, the growth outlook is significantly better today. Second, I think the monetary policy regime, having embarked on a flexible inflation targeting regime, to suddenly change tack, sort of do an intermeeting hike to try to defend the currency sends extremely confusing signals when clearly the inflation and even the core inflation momentum appears to be quite stable. So there is absolutely no need to panic at this stage. I think from the policy side, yes, both for the Reserve Bank and for the government, it is definitely time to dust off the policy options that may need to be use the bullets that may need to be used going forward if this sort of overshooting continues going forward. But no panic is necessary at this stage.
So that is on the rupee, right? I mean, what do you think the government can do to ease the burden of higher fuel? So far, I guess we're ruling out a cut in taxes because the government has said that they don't have bandwidth for higher expenditure, especially in an election year. But any announcements on how to sort of ease the burden of higher fuel?
Yeah, I think, that's an important question because, the burden is coming both from rupee depreciation and from higher oil prices. And I think at this stage, the fiscal orthodoxy is a lot more important than, the center delivering a 2 rupees cut in excise duty. That's the last thing India should be doing when there's sort of a panic amongst investors. What can be done, I think, is perhaps at the state level, because states do impose ad valorem tax on petroleum products, and states should be earning a lot more revenue as compared to the center, which actually levies a specific duty. Also on the GST front, while the center is seeing some pressure, states, in the worst case scenario, have a guaranteed 14%, sort of that commitment that is there from the center. So I think there's a lot more space at the state level because of these two reasons, and states could look at reducing their VAT.
Okay, states could look at reducing VAT quickly. We don't have too much time, Sajid. So your last comment on anything that could be done with respect to fuel?
No, I think we have to hold our nerve. I think the worst possible thing at this point is to buckle when oil prices go up to 80. The fact, as Sonal correctly said, is the need of the hour is to show fiscal orthodoxy. The last thing India wants is, to indulge in some urban populism, and that causes bond yields to go up, and that results in more nervousness on the rupee. So, tough times sometimes require holding your nerve. I think the government needs to be credited for doing that. And, over time, one can talk about rationalizing taxes on fuel, but you don't do this from a position of weakness. This has to be thought out in the medium term. Right now, I think stick to first principles. Hold your nerve on fuel prices, maintain the fiscal target. RBI should take whatever measures are appropriate if inflation concerns arise, and we should send the signal that if there's marked overshooting in the FX market, policymakers have enough instruments at their disposal to counter that.
Okay, so reassuring words from the government are enough. No action is needed as of now. No panic button needs to be pressed. Thanks, guys, for joining us.